and maybe early mid 2024, we're looking at rate cuts. But we've got to get.
In this video, Jim Rickards discusses the intricate dynamics of the global economy and its impact on financial markets. He highlights the challenges faced by China, particularly in their supply chain amid the COVID-19 pandemic, and delves into the Federal Reserve's perspective on inflation and interest rates. Rickards emphasizes the discrepancy between the Fed's actions and market expectations, providing insights into potential scenarios and their implications for investors. He concludes with a comparison of different narratives in the financial realm and their respective implications for investment strategies.
It actually is an interesting supply chain twist there, because the Chinese were more or less told, you have to self-medicate. We don't have the hospital beds for you. So they went out and stripped the shelves of ibuprofen, Tamiflu, Motrin, cough medicine, whatever they could get. The Beijing actually said, go back to TCM. Like, what's TCM? It's like traditional Chinese medicine, herbs and teas and things like that. Well, I'm not knocking it, by the way. Some of that stuff's pretty healthy, but they're at a primitive level. They're like kind of at the Bronze Age level. But that is hurting the economy as much as the zero COVID. They had no good ways out. I'm not saying one's better than the other. They're both awful, but you still have a lot of things that are not COVID. The real estate collapse, the excessive debt, the demographic decline, just the impact of top-down management when you can't possibly get everything right, and decoupling from the U.S. and the U.S. cutting off, high-tech exports to China, including third country exports where they're relying on U.S. licenses or equipment. So China's in a deep hole, probably in a recession. Japan, same thing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. And I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. And Jay Powell is probably sick. He's given 6 speeches, either post-FOMC meeting press conferences or like the Brookings Institution speech at the end of November, Jackson Hole, August 26th. He keeps saying the same thing. He says, inflation is job one, period. We're not really worried about anything other than inflation, and we're not going to rest until we get it down to 2%. And he said, we're going to have a recession. He didn't use the R word, but you don't need a decoder ring to figure that out. He said, unemployment is going to go up. And the Jackson Hole speech, he used the word pain like 5 times in one paragraph. I've been doing this for 45 years. I've never heard a Fed chairman use the word pain. He said, there's going to be a lot of pain. You're going to feel the pain. But the point is, he meant it. And they've been going down that path. So what are they trying to do? They're trying to get to something called the target rate. And you say, hey, Jim, what's the target rate? Well, I don't know what the number is, but neither does Jay Powell. Nobody knows what the number is. But the theory is the target rate is the rate at which rates are high enough that inflation comes down on its own without further rate hikes. That's the definition. So what's that number? And the Fed thinks it's 5.25. The market somehow thinks it's like 4.75, which we just got to, or maybe 5, but it's most likely 5.25, possibly higher, but I'll settle on 5.25. The Fed's not there yet. They're going to have to raise another 25 basis points in March 22nd. That's next FOMC. and again in early May, that those two additional 25 basis point rate hikes, in addition to what we've just seen, will get you to 5.25. And then from there, you go to the pause, and they use the word pause, and Powell's like, that could last a year. And maybe early mid 2024, we're looking at rate cuts, but we've got to get inflation under control. And it's not, I mean, inflation has come down a lot. If you just, it started dropping like a stone in July. Now I'm talking about CPI. The Fed uses, it can't be that simple with the Fed. They use PCE, personal consumption expenditure, core, meaning throw out food and fuel. Most people are like, what? That's what I spend most of my money on. But anyway, that's how the Fed does it. I always say if you want to understand the Fed, you can't use your mode. You have to put yourself in their minds, or you're just going to get it wrong. So PCE core comes out monthly, but they do a year-over-year comparison. That's what they want to make 2%. But just using CPI, which is better known, has come from round numbers again, 9, 8.7, 8.2, 7.5, 7.1, and now it's down, around 6 or high 6s. That's a lot, but you're still pretty far away from 2. So nice job so far, but you're not where you want to be. And the Fed said they're not going to rest until they get there. Now here's the Fed's, I hate to use the word conundrum, but sometimes it applies. Here's the Fed's conundrum. They're raising rates and inflation's coming down. That's clear. But what they don't know is are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it? And that's a big deal, because if they're at the terminal rate and they just don't know it and they keep tightening, which they are going to over tighten, probably already have, and this is going to be part of what throws the economy into severe recession. So that's kind of what the Fed's doing and how they think about it. Now, let's go to our next Irish storyteller. This is the market, and in particular, although here we probably have to distinguish between the stock market and the bond market. Bond market's a lot smarter. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, the Fed will get the wake-up call, pivot, the famous word pivot, meaning cut rates, and that will bring the economy in for a soft landing. So this is the soft landing Goldilocks, wrong fairy tale. This is the soft landing Goldilocks scenario where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. Yeah. The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German Bunds yield curve, and then, there's a million yield curves. Pick your maturity, but even you can look at the spread between 3-month Treasury bill rates and